Hello and welcome back to our business tips. Michael Lapide here talking to you about what is the best structure for your business. This will be the last video in this series, and we're going to talk about limited partnerships or LPs. Now, limited partnerships are special forms of partnership, and they're often used for investment purposes. So where investors want to come in, give money, get not much liability other than the money they put in. They just want to put their money in and be a partner still, get a piece of the pie, so to speak, get their money back without having to control, run, or do anything company. And then you have a general partner, so those are the limited partners, and you have the general partner, which is the partner that manages, does take the liability, maybe charges a management fee, and oversees the project of the limited partnership or the business of the limited partnership. Okay? Now, LPs also will have, at the end of the day, units to sell. So similar to shares, they'll sell limited partnership units typically, and the investors will buy so much per, say, per 5,000, per 10,000, whatever, to get in. And those partners, when they invest, again, they're only liable for the money they put in only. Now, there may be some specifications in the limited partnership agreements of, say, a cash call, for example. If you're in a business and the business needs money, then maybe all the partners need to buck up and put some money in, right? That sometimes happens depending on the agreement. So you've got to read that limited partnership offering in the agreement very clearly to know what you're getting yourself into. Now, some advantages is the limited partners have limited liability, obviously. We love that. So you put your money in, other than the money you put in, there's no other liability. Now, here's the other thing I really like is both income and losses are flowed through to the limited partner. So if there's a loss for the year in a business, you actually get to write it off as an investor, right? So the company doesn't hold the loss like in a corporation. It actually flows through, okay? It is easy to attract investors to LPs. Most sophisticated investors are used to limited partnerships. And it allows for experienced general partners to really use their expertise in running the business because you're in control. That general partner's in control. It's got all the money from the limited partners, and you can run with that. And limited partners can also leave the LP without dissolution. They can sell their units, you can buy them back, whatever, and doesn't affect anything. The business carries on. Now, disadvantages, of course, there's more filings, formalities, the structuring costs a lot more money. Obviously it's a fair amount of legal fees to set up the structure. General partners, got to remember, they do assume the liability as a general partner GP. And of course, much due diligence. If you're the investor, you got to do a lot of due diligence because you're trusting your money in the general partner's hands. So you're looking at the agreements. You're looking at the business plan itself. How is it going to look? And you're looking at that general partner to make sure there's someone you can trust and is going to do the job. If you got any questions, let us know. Please post in the comments below, and we'll look forward to seeing you in the next video.